Welcome to Framework Fortune. I'm your host Ben, and in this video I'm going to be going through step by step how to start becoming a consistent profitable trader. With all the GameStop hype all over social media, a lot of you are new traders coming into the market. So hopefully before you make a trade you get to see this video and it will put things in perspective and you will know a lot more by the end of it. So stick around to the end. And if you haven't yet, go ahead and hit that subscribe button. And anytime during the video you feel like you're learning something, hit that like button. So let's start. And before we even start about how we're going to trade stocks and all that, there's a few things that you want to understand. Number one, value. So what is value? I'm going to ask you a question and I want you to take a minute and think about it. Pause the video if you have to and just think about the question and then answer it and then press play. What is the value of an iPhone or any Android phone? What is the value of this? Go ahead. Pause it. Okay. So, the value of this or an iPhone or anything else, any product, any service, gold, silver, stocks, all of that have no value. None. Now you may be thinking to yourself, well, I know it's got value because I paid $800 or $1,000 for this iPhone. Yes, you paid a price for it. Price is different than value. And this is very important when it comes to investing, trading, or anything in the financial markets to understand. If you take that same iPhone and throw it into space, or throw it in the garbage, or throw it across the room, it doesn't have value. That iPhone only has value when one buyer and one seller agree on a price. Until that transaction is finished, whatever the product, service, or whatever it is, has no value. Now, you can value something as a collector of cards or something. You might value cards a whole lot. But if nobody's willing to pay that price that you value those cards at, then they don't really have any value, do they? So, value is between a buyer and a seller, an agreed upon price. In life, you pretty much could negotiate anything if you really wanted to. Like if you go to a car dealership, you can negotiate the price of that car because the price of the car that they've put on it is what they are valuing the car at. You, however, have done your research on buying that car and you value it for lower than the price that they're asking. So that's how a negotiation happens and value is created. It has been around since the beginning of time when there was two humans and one traded a rock for a fish or two rocks for a fish. The fish had value to one person, the rocks had value to another person. They didn't have value until they traded those rocks and made an exchange. They had the thoughts of value, but they didn't actually have any value. So it's the same thing with anything else in your life. Your iPhone, the food that you eat, anything. The value is only there when there is a buyer and a seller. And this is going to be kind of an eye-opener for a lot of people, but you're going to need to understand that concept when you're trading stocks. Because when you realize that these stock prices mean nothing, it's the value between the buyers and sellers of stocks that create those prices. And that's why those prices change. That's why you see on GameStop, this got pushed up. Fundamental investors and traders knew that GameStop had terrible value. A whole lot of them had short positions expecting this to crash. So they did not think that the price was where it should be, and they were trying to value it lower. And what happened? A whole bunch of other people on Reddit decided that they valued it a lot higher, and a whole bunch of people kept buying. So the price keeps going up. So the prices are really irrelevant, essentially. The price is just a measure of the value between a buyer and seller. And that's why prices change constantly. If prices meant anything, they would be set prices forever. Gas is always changing prices, for an example. So you have to understand that concept of value. Now, the next concept is supply and demand. And understanding value will help you with supply and demand, which will also help you when trading stocks. If you don't know what supply and demand is, it's how these transactions happen and how people will value those type of things that I was talking about. So when you have a whole lot of supply, and in this instance of the stock market, the sellers are the supply because they are selling the supply of shares to people, right? They're supplying the shares, so they're the supply. So then your demand would be your buyers. So when you have way more demand and there's not a whole lot of supply, prices go up. So there was not a whole lot of people selling GameStop at those prices they wanted to sell at, those shorters and stuff, when all of a sudden all those buyers came in and pushed it up. There wasn't enough sellers to make transaction with every single buyer. So supply and demand is in everything in your life. If the supply of oil is short because of whatever reason, then and the demand for gas is high, which we know it is, because we're always putting gas in our cars every other day, then the price of gas goes up. If there's a whole big abundance of oil, say some big company just hit another oil fill or whatever, then there'll be way more supply of oil than there is demand. So the price of gas will go down. So you have to understand value and supply and demand and then put them together, right? So when you're looking at the demand and the supply, when you're looking at the buyers versus the sellers, you have to understand what is the value that these buyers and sellers are going to agree upon. And is this stock something that the buyers are going to demand a whole lot of because they're trying to value it higher, and then sellers on the other side are transacting with those buyers and selling at those higher prices as well. And buyers can become sellers in the stock market just like sellers can become buyers. So say there's a buyer buying a stock at $1, and he knows there's a whole lot of people who will sell at $1.25. Well, that buyer will become a seller at $1.25. The stock market is not a place to play games with. You need to know why you are getting into stocks. You need to know why you are buying and selling. If you don't know why you're buying a stock, you're just buying it because somebody on Reddit told you to buy it. That's like going to buy a house in another country because some random person hit you up on WhatsApp and said, buy this house. You have no idea if that house is even there, or if the house is together, or if it needs thousands of dollars of work to fix it up, or if it's even their house to sell. So why would you buy a stock or a piece of gold or any type of investment without knowing why you're buying it? At that point, you are just gambling. And you can get lucky in the stock market. Anything is possible in the stock market. But you're not going to be consistently lucky. You may get one big rip and make a whole bunch of money. And then you might start to think, oh, I know what I'm doing. And then you go and start trading other stocks and you start losing all that money. You're not going to keep getting lucky in the stock market. And the stock market is also full of scams, manipulation, big money moving around all the time, hoodoo, all types of stuff. I have a video about the dark truth of the stock market that you can check out. It's one of my older videos that I made. But everything I said in that video, which was made a year ago or maybe 2 years ago, is still true today. If you had seen that video back when I posted it, this GameStop stuff wouldn't have been that big of a surprise, because this type of stuff happens all the time. So that's why you need to know why you're buying and selling a stock. Because if you don't, you can get caught up in something like this in GameStop. And I guarantee some people bought up here at 483. I know they did, because that's where the price hit. And you can't get that price without somebody buying it at 483. So whoever bought it right there lost a ton of money. And it was probably somebody thinking that, oh, this thing's going to keep ripping because everybody's saying it's going to rip. Well, if everybody says to jump off a cliff, are you going to jump off a cliff? Is the old saying that my mother used to tell me. No, I'm not going to do something because other people are doing it. That's a terrible idea. We're all adults. We should know that by now. Even if you're a young adult, that should be a pretty clear lesson that you don't just follow people blindly. You have to do your research and understand that when you are trading in the stock market or the crypto market or the gold and silver market, any of it, there are going to be things that are sketchy. There's a lot of sketchiness when it comes to money. These are investments, and there is some rules and laws that the government and the SEC has put in for our protection. Now, whether or not you believe that or not, that's on you to decide. But there are also laws for murder. And guess what? Murder still happens all the time. So it doesn't matter how much government regulation or control there is in the stock market or any markets, it's still not safe. So you need to understand all of the bad stuff that can happen. Now, I'm not trying to scare you away. I'm just trying to give you the truth. And yes, you can make money in the stock market, but it is not an overnight get-rich scheme like everybody is starting to think it is with this GameStop stuff, okay? So don't worry about missing out on GameStop. There will be plenty of more opportunities in the stock market and crypto markets to make money. You're better off being consistent and sitting out while you don't know what you're doing than jumping in and losing all your money and saying the stock market is a scam. GameStop was kind of a scam. It was a manipulation of sorts. And those exist. But if you know when and where these scams are happening, if you know how to notice them, then you can avoid them or you can capitalize off of them. But if you don't know, then you're not going to know what you're doing, and you're going to buy in up here at 483, and then the stock will dump on you all the way down to 265. So that's it for the concept part of this. Next, we're going to dive in to actually getting to trading. So stick around. Once you've learned those concepts, you need to get ready to start making action. You can learn everything there is to know, but until you apply that knowledge and actually take action and get experience, all that knowledge is useless. So you're going to want to research a broker account. And you've probably heard of Robinhood, which for a long time I've been very adamant of steering people away from that phone app. And when it comes to day trading, honestly, you really shouldn't be on a phone app at all, because if you're trading in and out quickly on some of these stocks and you drop your phone or your internet service goes out or something like that, or the dog jumps up and hits it out of your hand, then you might lose some money because of an accident. And then phones are a lot more prone to accidents than trading on a desktop. Sure, the internet can go out on a desktop, but most likely your dog is not going to jump up and knock it off of your desk or whatever. So if you're looking for a broker, you really want a desktop platform. If you are doing swing trades or longer term trades, then phone apps can work fine for that, but I still don't recommend Robinhood. I would recommend Weeble's phone app over Robinhood, and there will be a link in the description, and if you sign up, you get free stocks. You know how all that works, but it is there if you would like that phone app. But if you don't want to trade on a phone app, if you want to take what I'm saying is a desktop platform is a better option, then you probably want to go with Thinkorswim, which is currently, I think, still under control by TD Ameritrade, but is getting traded over to Charles Schwab. So you either have to go to TD Ameritrade or Charles Schwab to find TOS, the Thinkorswim platform. Now, Webull does have a desktop platform, and it's pretty good. The only problem is you have to pay for level 2, and we'll get into level 2 in a little bit, why you need level 2 to trade. But all you got to do, put in stockbroker in Google, and you can see you've got interactive brokers, and we got all these different options of different companies and stuff telling you about different stockbrokers. So you can look into all these. You can see right there, there's another one, and there's Charles Schwab. But there's plenty of brokers out there. Do your research on the broker. You want to know if you're trading with commissions or if you're commission-free trading. Most of the brokers now offer commission-free trading, which starting out as a new trader, you're not really going to want to trade a whole lot of money at once. You really only want to trade 1 or 2 shares of some stocks, only like 20, 30 bucks, maybe 50 bucks, something that you are willing to lose. So getting a broker that is commission free will help with that, because if you're just trading small shares like that and you've got to pay $5 or $6 every time you buy or sell, you're going to eat up all your profits and all your money in your account. So make sure the broker is commission free. TD Ameritrade is commission free. Webull is commission free. So, and if you're looking for something like a crypto type of platform, Voyager is also commission free, and I will put a link for Voyager in the description as well. But those are things you want to check in. Now, the process to sign up with a broker, it's a little bit of a long process, but it's the same thing as signing up for anything else, like a bank account, because a broker basically is a bank account. You're putting your money in that account, and some of them offer Visa cards. Thinkorswim offers a Visa card, so if I have money sitting in my account, I can buy things with that Visa card. So it's just like a bank account, but you want the cheapest options, but with the best bang for the buck. And to be honest, Thinkorswim is the best one I've found so far, and that's what we're going to be diving into as far as the platform. Alright, so here we are inside the Thinkorswim desktop platform. That is what you see behind me. One thing I forgot to mention about choosing a broker and all that, when you sign up for an account, you'll have an option between a margin account or a cash account. Do not do margin. Margin means that they're going to be loaning you money on top of the money that you have in there, which sounds like could be a good thing. But if you lose more money than what's in your account, then you have to pay that back from whatever you borrowed on the margin. And there's a lot more restrictions to trading when it comes to making margin trades. And one of those things is the PDT rule. And the PDT rule is pattern day trader rule. And the government or the SEC or whoever put this rule in to supposedly help new investors and traders mitigate risk. So if you're on a margin account and your account value is under $25,000, then you can only make 3 trades a week. If you're over $25,000, however, you can make as many trades as you want. But if you make more than 3 trades a week and you're under 25K, you will get flagged as a pattern day trader, and after a couple of flags you may get some warnings on the first 1 or 2, but by the 3rd one you can have your account locked up, suspended, whatever else. So you don't want to go down that route. You want to choose a cash account. And there's some other options for accounts like IRAs and Roths and all that. Starting out, just choose an individual account and make sure it's an individual cash account. Because on an individual cash account, you can get around the PDT rule. Because the PDT rule does not apply to cash accounts. However, it does take 48 hours for your funds to settle with a cash account. And what that means is if you trade $50 on Monday, you will not be able to trade with that $50 again until Wednesday when the funds settle. Now, starting out, like I said, only trade with a little bit, so you may not be able to make that many trades. But you can also do what's called paper trading as well, which allows you to trade with fake money in the real-time markets. And Thinkorswim offers this option as well as Webull. I'm pretty sure. I think Webull does. So you may be thinking, how do I get around the PDT rule? Well, with that small amount of money, you're probably not going to be able to make a whole lot of trades there in a week. But once you go up to like $1,000, you just split your account in half. Only trade 500 of it Monday. Then trade the other 500 Tuesday. And on Wednesday, your 500 from Monday will be settled and ready for you to make another trade. So if you split your account in half, and I'm not saying physically do that, like there's not a way to actually split your account in half. I'm just saying mentally, only trade half your account on Monday, half your account on Tuesday, and you will be able to trade at least once every single day that the market is open. If you do it that way, and you can get around 5 to 6, maybe 7 or 8 trades versus the PDT rule where you're only getting 3. So individual cash account is where you want to be. Plus, it's way less riskier because the money that you lose in your account on an individual cash account is the only money you lose. If your account goes to 0, that's it. Margin, if you take a huge loss and it's more than what's in your account, you have to pay that back. So stay away from margin as a new trader. Alright, so the next thing you want to learn about is support and resistance. And it's very important that you understand the value and supply and demand when learning about support and resistance. So we're going to dive into some charts and I'm going to show you how to find support and resistance and what it is. So, support is a price level where a lot of buyers will be buying at, and most likely will not go below that price unless the sellers outweigh the buyers. If there's way more sellers than buyers at a support area, that support level can crack. A lot of times those support areas hold up at least for a little bounce or something like that. So think of the support level as a floor of the price. Resistance is going to be the opposite. The resistance is going to be a ceiling. It's going to be a price level where a lot of sellers are going to be at, and it's going to take a whole lot of buying to take out those sellers to break through that ceiling. And my metaphor I like to use is Mortal Kombat. If you've ever played Mortal Kombat, especially the older games, if you're Scorpion and you uppercut somebody through the ceiling, that momentum pushes them through that ceiling. So it's the same thing. If a whole bunch of buyers are acting like Scorpion and they're coming running in and buying all the stock up into the resistance, and they can actually beat the sellers at that resistance line, then the sellers are thrown up onto the next level, like if you was Scorpion fighting Johnny Cage. And that's when you get those breakouts. So if you still have questions about what support and resistance is, you can go and check the day trading playlist lesson for the support and resistance lesson, and I'll go into much more detail. But now I'm going to show you how to find this support and resistance, and there's multiple ways. So we're going to look at this chart. This is NCYTT. Now, these are candles. Okay, if you don't know what a candle is, this is a measurement of the price movement within a time frame. So on this chart, this is a 5-minute chart. So each one of these candles is 5 minutes. There's a time period of 5 minutes. And I have a video in the lesson on candles and understanding them better. But here's the basics of candles. This candle here that I'm pointing to opened up at the bottom there at $12.98. Buyers pushed it up, and then it made this little wick here. And then right at the end of the 5 minutes of the candle, it came back down and closed right there. So if it is a green candle, that means that the candle opened up below and the price raised up and closed higher than where it opened. The red candle is the opposite. So this red candle here, this big red candle there, it opened up here. And it looks like it had a little push up with this wick, and then it sold off. And then it came back up just a little bit and it closed right there. So these wicks are just price movements outside of the open and close of the candle. Okay? The body of the candle is how you'll be able to tell the open and close. So in a green candle, the open of the candle's there and the close is there. These movements happened outside of the open and close, so you get these candle wicks. Selling candle, the open is here at the top and the close is down here. So that's a basic introduction into candles, and the candles can be measured with volume bars down here. And this volume, okay, it's not like sound volume. It's not like turning the volume up on your speakers. Volume is the amount of shares traded in a time period. So all the shares that were bought and sold. So if you see a green volume bar like this one here, that means there were more buyers than there were sellers in this volume bar. More people bought the stock than they sold it. This big red candle, what do you think? A whole lot of people sold the stock, and it was more people than the buyers. So that goes back to the supply and demand. So you got to understand that supply and demand. That's why it's important. We're going to keep going back to supply and demand. So now that you understand the candle somewhat, we'll talk about support and resistance. Now, when multiple candles hit at a price level, that level could be considered support or resistance. So for instance, here on this stock, if you take a line and you look at these candles, where's a lot of these bottoms of these candles hitting at? Kind of looks right here. So we're going to draw that line right across there. Maybe a little crooked, but you'll get the point. But you can see the stock popped up over that line right there, and then it came back down. This red candle sold off, and then it bounced off of that line. Came back down, bounced off of that line. Came back down, bounced off of that line. So this is your floor. This is your support area. Buyers were coming in and buying at each one of these points. Where you see the green candles right after the red candles, that's where buyers were coming in and held it up. There was enough buyers to outweigh the sellers. The sellers could not drop the price any lower, so that area became support, and it would be straight across there. So I'm going to draw that. I'm going to draw it again, try to make it straight as possible. So we got one support area there. Now, where is resistance? If the bottoms of the candles are hitting all near the same spot for support, then the tops of the candles are going to be hitting resistance. And you can see this kind of right through here. This stock, we can draw this line right across. This candle come up, it hit right there. It actually went above it, but where's the body of the candle at? It's way back down here. The body of the candle didn't close until it was back below this line. And it popped up again, and what happened? Sold back down again. See, this line did not hold as any support, right? This new ceiling didn't become a floor. It dropped right back down, and it had those bounces. But you see it kind of come up right there, got close to that resistance, but over here you can see it popped up, hit that resistance again, sold off, and came back down. Now here we have a break of resistance. This is the Mortal Kombat reference. This is Scorpion right here. This is all the buyers. They tried to uppercut the sellers once into the ceiling. It didn't work, so they tried it again, and boom. You got a nice breakout there at that break of resistance. So you draw a line all the way across. Now what happens? Goes up, comes back down, and now these candles are hitting that resistance line. But the resistance is no longer a ceiling, it's a floor. So old resistance, this line was resistance back through here, can turn into new support. So that ceiling became a floor when you got enough buyers to push this way up, and then buyers were still buying at that ceiling. That ceiling became a floor. So old resistance can become new support, just like old support can become new resistance. They can change depending on the buyers and sellers. Remember, value, supply and demand, all that, it's constantly changing. The prices are constantly changing. So the support can turn into resistance. The resistance can turn into support. But you can see that bounced off there. But where's more resistance? So if this is the new floor after this big run, well, where's the resistance at? Well, you can see this line back here, this big candle, and you can connect the dots. So that candle hit there, this candle hit there. It did get a little pop above, but it dropped down, bounced off of that support there, came back up, back down. Hit that resistance line again, back down. Hit it again, back down. Hit it again, and this time it got enough buying volume to break back through that resistance. And what happened? What do you see here? That resistance right through there became new support, and the stock held up. So one more time, where's some more resistance? Top of this candle. Whoops. Now, not all the candles have to match exactly, but you want to see majority of the candles at the same area. So like this, you can see those candles kind of popped above for a second, but this is new resistance, right? So there was a bunch of sellers sitting right there, and when the stock finally came back up to there, what happened? It hit it, went back down. Hit it, went back down, and buyers could not come through to push this through this top resistance. So how do we use support and resistance? We use it for our entries and our exits. Most of the time you want to have an entry near support. If you buy here, okay, and then you put a stop loss down here a little bit, well, you're probably not going to get stopped out, and then you're going to get this massive run, but you bought towards support. If you buy right here in the middle, say on this candle, you're not buying at a support or resistance level. So the price could go up, but it could also drop all the way back down to the support level like it did. So the closer you can buy in the support levels, the better, but that's not always the case of where you want to take an entry. There can be multiple places to take entries, and we'll get into that in just a little bit. So your resistance is going to be your sell areas. If you bought in here, it runs up, it doesn't break, you can sell some of it or all of it right there. You made a nice little profit. It comes back down if you decide to hold some of it, and then it breaks and comes up. Well, you saw this candle hit up here, so you would know that's kind of some resistance, so you would know to sell some more right here at that resistance area, or sell all of it. Now, you can also use it for the short side. If you don't know what shorting is, it's going against the market. So when you're shorting, you would just do the opposite of what I'm saying on all this. Instead of your entry being down here on a short, you're going against the price of the stock, so your entry would be up here. This was your exit for going long, but this would be your entry for going short. And then you would exit down here. Because when you short, which as a new trader you shouldn't be shorting, but when you short, you are selling shares that you don't own. You're borrowing the shares from your broker to sell, thinking the price is going to go down, and when that price goes all the way down, then you buy those shares back. And that difference in price and the price drop is the profit that you make. Now, if it doesn't drop, and this would have kept ripping, well, you got to buy back in, so you're going to be buying at a higher price, and that's going to cause you to lose money for shorting. And that's what caused the whole GameStop thing, was a short squeeze, where you had a bunch of shorters sitting here at this resistance, or at this resistance, or at some resistance on GameStop, wherever the resistance was, and the buyers overweighed the sellers at that resistance and pushed it over that price. So then those shorters had to cover their positions and buy more, or buy the stock back to give back to their broker, pushing the price up even more. And that's how a short squeeze works. So you have multiple resistance and support areas on every stock. This is one form on the intraday chart, and the intraday chart just means inside of a day. The 5-minute chart I've got on is a 5-day, 5-minute, so I can shrink this and go back and you can see this is 5 different days. But this part of the chart right here is intraday inside of the day here. So now if you're looking at a daily chart, and this chart is a 1-year, 1-day chart, you can see past chart resistance and support on here as well. So if you look at this whole chart of the last year of this stock price, where's resistance at? You can see a candle hit there. Just draw that line, see if it connects to any more candles. And you can see there, it hit there, hit there, hit there, hit there, did break out, dropped down, kind of held up there, and then bounced off of that old resistance. But you can see that line right there is going to be some resistance in your intraday chart. And what price is that? 11.13. So let's look here and see if 11.13 had any resistance on the intraday chart. And actually when the stock opened up, this was actually a support line. It was resistance before, you can see back here, and it finally broke out of that, and then it bounced off that old resistance, bounced off, and then went on this nice run. So that was that resistance line up there. That old resistance back here over the past 12 months became support over here once it was able to break out. So that's your past chart, support and resistance on the daily chart. Same thing as in the intraday chart. You can go through, you just draw on lines on those candles. It's a good exercise to do to learn support and resistance. Draw lines on the charts where you think the support and resistance is at, and then the next day look at where those prices hit at, or intraday, and see if you were right about that support and resistance. Most of the time, if you're doing what I'm telling you to, that will be support and resistance. So support and resistance is very important. You also have what is called natural support and resistance, and this is every 25 cents. So from $1 to $1.25 to $1.50 to $1.75 to $2, all those are natural support and resistance because it's a psychological thing. It's easier to do the math on a quarter, 25 cents, every 25 cents, than it is to do like math on 28 cents and 35 cents. 25 cents is a nice increment that most traders can think very quickly, okay, I'm up 25 cents, I'm going to hit sell. Or the stock just dropped 25 cents to a support line, I'm going to buy. So that's your natural support and resistance, and it's just 25-cent increments all the way up. They can be strong support and resistance, or they can be weak, but they still are something that you need to be aware of, because sometimes these stocks can break out over a resistance line. Like there was resistance here on this stock, you can see, but it got held up right there at $2.95 because every 25 cents, so $3, will be a natural resistance line. Then you also have your indicator support and resistance, and if you set this up with the Thinkorswim setup video like I showed you, then I talk about a little bit in there, but you can see these lines. These are different moving averages, and these moving averages are the cost of the price averaged out over a time period. So this red one is a 200-day moving average. So it's the price averaged out over the past 200 days. That can be very strong resistance. You can see where this red line is at. The stock has rarely got above that red line and held, because that 200-day moving average will act as a lot of resistance. And you can see when the stock got above the yellow line here and this blue line, well, this blue line is a 50-day and the yellow is the 100-day moving average. So you can see they bounced off of those lines, and then you got a nice rip up. So those can act as support and resistance as well. And that's going to be your 3 support and resistances: natural support and resistance, past chart history support and resistance, and indicator support and resistance. Alright, so now that you understand support and resistance, we're going to talk about price action. Now, price action sounds exactly like what it is. It's the action of the price. So, to understand price action, you got to understand the supply and demand, the support and resistance, the buyers and sellers, the value, all of that. Once you've understood all that, you can now look at these candle charts and look at this level 2 in this time and sells, and you can kind of get an idea of the price action. So looking at this chart, the overall price action is in an upward movement, as this line shows. So when you have price action, the upward movement, this means you have a lot more buyers controlling the price of the stock. Now, it did drop down, so you got to look at this other price action as well, because when you're trading during the day, especially day trading, if you start out and it's looking like this, everything's looking good, you start selling off there, and then and a little bit of time goes by, you can see the buyers were buying this up, pushing it up. Remember, volume bars equals how many shares are traded. So there was a lot of buyers coming in here, pushing this up, little sell-off, more buying, little sell-off, and you can see the volume bars correlate exactly with the candles. More buying, very little selling right there, and then you started getting a whole lot more buying, and you got this nice rip. So that is the price action that you're looking at. You're looking at which way the price is going. Now, once it got way up here, it hit a resistance line or whatever, but it just went on a nice rip. So after you have a nice rip, most of the time you're going to get some type of people selling the stock. So looking back at this, even though the stock came back down, it came back down to what is called a trend line. And a trend line is support and resistance. It's just not a floor and a ceiling. So it's more of an elevated floor. So you can see it wasn't one price there back here that held this up, because the price action was pushing the price of the stock up. But the sell-offs will still happen because people are going to be locking in profits after nice rips like this. So you can see it shot up, came back down, bounced right there, came back up, sold a little bit, then curled around right there, and then had a nice big explosion before it ended up selling off and coming back down to the bottom of this trend line. So the bottom of this trend line is your support on this chart here, when you see these upward movements in price action instead of like a sideways movement of price action. So the overall price action is an upward movement. And if this chart was inversed and all this was over here, then it would be coming down. And so here's GameStop. Now, what is this price action telling you here on GameStop? What's the overall direction it is moving? So draw a trend line. You're going to draw it the opposite of the other way. But you can pretty much see it's under this trend line and the price action is pointing down. So when you see the price pointing down, you're most likely not going to have any big breakouts or anything like that. Now this was GameStop, so there was craziness, but you can see overall the whole entire day, GameStop ended up selling off down here. So it opened up way up here, but the price was a lot lower. So you had a lot more selling price action than you did buyers. So it's just the opposite. Now just like the uptrend support, this line is now a resistance line. It's just a sloped resistance line instead of a ceiling. So it's still a ceiling, it's just a sloping ceiling. Now there's not really too many candles to attach it up to here, so I'm just going to draw it down so you can see kind of there. You got a candle hit there, candle hit right in there. There was a little breakover, but it ended up coming back down below that line, and you can see these candles hit right against that line there. Now with these downtrends like this, once the downtrend is broken, you can actually get a little pop up. You see there, the stock popped up after the price action was broken from the downward trend to the upward trend. So the overall price action of the day was selling action. Now there was some buys, but look, if you take the same thing I was talking about, this downtrend line right there, right? See all the selling? When it broke over that downtrend line, quick little pop. So the price action was saying this is a lot of selling, and now buyers are coming in, and the price action now has changed to upward momentum. So once that happens, once that crossover happens of that resistance, you get a nice run. And then what happened again? Draw another support line here, another trend line. You know, and these are pretty steep trend lines, but this is GameStop, so that's why it was nonsense. But you can see, held right up on that trend line to up here, and then it sold off, and then started coming back down. And then this trend line came straight back down there. It's a little crooked, but you get the point. And then it crossed over that trend line, and now the price action moved back up. Same thing again. And then if you draw the trend line there, on the way up, trend line cracks, goes back down. Until you get another reversal and you got a little pop there. So trend lines are support and resistance as well. They're just sloped, and you just do it the same way, matching it with the candles. So price action is the price movement of the stock throughout the entire day and in the intraday. Overall, if you get into this stock here, and then you're starting to see when it hit this line up here that it wasn't going to break out, that it held up as some resistance, then you know the price is probably going to continue in that direction, in that downward direction, until the stock can cross over that top resistance. And we go back to USEG. Overall upper price is moving up until it cracks, and then you have a little sell-off. But really this kind of bounced off this support. I mean, it dropped a little bit below but came back up, and then now you can see it's below the trend line, and it is climbing up some more, but still possibly this could sell off. But